So Michael Burry put out another comment this week along with Jeff Gunlack, and they're both calling AI overblown and a bubble, and they're giving all their examples. They're just wrong. I mean, I don't know how to say it. They're wrong. This is not a bubble. This is not 19.
That's a bold and unequivocal statement. Financial heavyweights like Michael Burry are simply wrong about an AI bubble. But with so much panic in the markets, how can Jordi Visser be so confident? Right now, many investors are feeling the pain. The speculative names that soared earlier this year have given up their gains. Crypto portfolios are bleeding, and the narrative that the AI-driven rally is over is getting louder by the day. In the face of this widespread fear, Jordi argues that this sentiment is completely disconnected from economic reality. He believes we're climbing a perpetual wall of AI worry, where short-term turbulence in high-risk assets is being mistaken for a fundamental collapse.
To understand his thesis, you have to first see how he separates the noise of speculative trading from the powerful underlying signals of corporate earnings and global growth, which remain remarkably strong. It's this kind of clear-eyed analysis that we aim to bring you every week. So if you appreciate cutting through the hype, be sure to subscribe to the channel for more insights like these. And while his breakdown of the current market is compelling on his own, he later brings the receipts, providing hard data that draws a stark contrast between today's AI leaders and the bubble of the dot-com era. But first, let's dive into why Jordi believes there's a light at the end of the current turbulence.
But you didn't even ask why I'm in Maine. I'm hiding here, so this is the best place to be. So I've run out of town. Yeah. What's amazing about this one, and what I think is both surprising but also enlightening, the S&P is still only about 5% off all-time highs. So when we went through this, and you're naming how sentiment in some measures is lower than it was on Liberation Day, yet we're nowhere near that in terms of just the S&P fall. So this has really been speculative retail names, and obviously Bitcoin. These have been the areas. And for everyone who's also lost money in altcoins, this is all of crypto. So this isn't just there. But I will say this. For everyone who's watched me here or on my weekly, I always say the same thing. And I think it gets boring to people, but I really do believe that we will be climbing a wall of AI worry forever. And I really do mean forever. Behind the scenes, as you know, we're seeing speculative names fall off, and I've highlighted that I created an index which had the names that I think were heavily speculated on, that really didn't have any revenues, that were based on things like nuclear, which may be a solution 5 years in the future, but nothing in the near term. And Bitcoin obviously falls into that camp where it doesn't have a normal valuation side to it. So we're at a point where people have basically bailed out for the time being, and they're getting stopped out. And as someone who, let's say, I had some really nice trading profits going this year until recently. And then about 2 weeks ago, I started to increase my, my regular buying of Bitcoin, of which there's always regular buying. Then I started to doing some increased buying below 100,000. So, between MicroStrategy and Bitcoin, they've eaten up a lot of my semiconductor profits and now my Eli Lilly profits. And we're kind of sitting here, and I can feel that the narrative, as prices are going down, I'm seeing more and more panic on the AI side, more and more people kind of beating their chests that this is artificial intelligence unwind and that the bubble is popping. And that's where this is really going to come down to it. I don't hear many people when I speak to them that use AI or that do as much research as I do across kind of what's coming. And I just feel like in a week like this or a month like this, a lot of this is just losses on top of losses. We were going to see corrections. That speculative name basket has given up the entire year, and it was up significantly. Bitcoin's given up the entire year. We've knocked retail out. So I wrote a piece this week that there is light at the end of the turbulence. I wrote one with a similar title back in Liberation Day, and I hate for people to ignore it. But the message is the same, which is when those fear and greed index get to these low levels, my historical kind of belief is unless the economy follows it, and goes down like it did after the housing bubble and like that, that's the only way that it's justified. If not, and we're in a bull trend, and I will remind people, every market around the world is up double digits. So even the S&P 500, and earnings growth is happening faster outside the U.S. than it is inside the U.S. And U.S. earnings are growing faster than what the market's up this year. So under the hood of everything, AI is still pushing things forward. We'll find a bottom in 6 months from now. People will look back and really not remember the panic that ensued.
Jordi Visser openly admits the recent market turbulence has been painful, detailing how his own speculative plays in assets like Bitcoin have eaten into his semiconductor and pharmaceutical profits. But he draws a critical distinction. This pain is highly concentrated. While the basket of high-risk names has given back its entire yearly gain, the broader S&P 500 remains only about 5% off its all-time high. For Jordi, this separation is everything. He argues the loud narrative that the AI bubble is popping confuses a necessary washout in speculative froth with a fundamental collapse of the real economy. As long as the economy doesn't follow these assets down, the fear is just noise. And right now, he sees the opposite happening. Under the hood, global markets are enjoying double-digit gains, and corporate earnings are actually growing faster than stock prices, signaling underlying strength. With this foundation laid, separating panicked sentiment from solid economic reality, he turns his focus directly to critics like Michael Burry. He contends that the popular comparison to the dot-com crash of 1999 completely falls apart under scrutiny. He's about to put the bubble thesis to the test, contrasting the two eras with hard data on corporate profit margins, the actual scale of the market's run-up, and the fundamental earnings power of today's tech leaders versus those of the past. His case begins not with a defense, but with an offense, pointing to forward-looking indicators that suggest the entire market is actually getting healthier and poised for even broader growth.
So I think next year is going to be a much, much better year for confidence than this year. And again, this gets back into my argument, and I've said it now for 5 months. PMIs are going higher. We're going to have a broadening out in the winners. I'll be highlighting a lot of stuff in this weekend's video that just shows that, like, Goldman Sachs estimates for Russell 2000 earnings for next year. I mean, people have to start paying attention to the fact that between the rate cuts and the fact that you can make the argument we're still coming out of a recession. If PMIs go higher, a lot of companies will be coming out of a 3-year recession. And part of coming out of a recession, and I think this gets back to coming out of the great financial crisis, it's not about things getting better. It's the second derivative. It's actually about things getting less worse. When things start ticking up, you start getting revisions going higher, and earnings revisions are still moving higher. It doesn't get talked about that often, but really over the last 15 years, there's very, very little time where we actually see earnings revisions going higher with the consistency that they are now. It's been about 20 weeks where they've consistently been moving higher. And that's across, the stock market. That is not just technology. That is not just AI, which means more and more companies are starting to say their earnings the following year are going to be better. And sometimes that can just happen through cost cutting. That can just happen from running your businesses more efficient. After NVIDIA came out, I hate to tell people, we have all-time highs for profit margins now. So Michael Burry put out another comment this week along with Jeff Gundlach, and they're both calling AI overblown and a bubble, and they're giving all their examples. They're just wrong. I don't know how to say it. They're wrong. This is not a bubble. This is not 1999. I said it last week on your show. I've said it on mine. I'm going to say it again. The 5 years leading into 2000, when we actually had a dot-com bubble, the NDX was up 800%. The last 5 years to today, we're up 100% in NDX. So it was 8 times as big a move. And Cisco is trading at over 100 PE. We still have NVIDIA growing earnings, and revenues are up 60+% from where they were a year ago. And just so people hear the numbers, their most recent quarter and their estimates going forward are over $60 billion in a quarter. I mean, there's just not a lot of companies inside the S&P 500 that are bigger than the revenues that they make on an annualized basis at over 200 billion. So this is not a bubble. AI is the most powerful thing I've ever been involved in. And for people that say it's overblown, I'll say it again. Eli Lilly's been up again this week. I talked about it last week. We are on the cusp of curing all diseases. It was all over the podcast I listened to this week. Pay attention to the things that really matter. If you're at a point where curing cancer, I want you to go into your chat GPT after this interview is over, and I want you to type in, what would the stock market do if we cured cancer, and see what result you get.
The video opened with a blunt declaration. Michael Burry is simply wrong, and this is not an AI bubble. Now, the full case is on the table. Jordi Visser's argument rests on a critical distinction. He sees the market's widespread fear as a direct result of confusing the painful but necessary collapse in high-risk speculative assets with the health of the real economy. While crypto and speculative stocks have given back an entire year of gains, the fundamentals tell a different story. He points to record-high profit margins, consistently rising earnings revisions across all sectors, and a market run-up that is 8 times smaller than the dot-com bubble of 1999.
The takeaway is a clear set of markers. When speculative froth gets washed out, but the underlying economy doesn't follow it down, the bull trend remains intact. And if corporate profits are real and broadening, it signals sustainable growth, not a fragile bubble. The true test, then, isn't the price of Bitcoin, but whether these fundamental indicators continue to strengthen. This disconnect between panicked sentiment and solid economic data remains the key battleground. Follow for the next update. We'll track this as it unfolds.